divided by 2. It's not the value that you would ascribe if you hired an independent valuator to fight the Internal Revenue Service or the state of New Jersey or a spouse in a divorce. It's really how much insurance you would buy. Because money spent, whether the entity buys or the other members or shareholders buy, is not tax deductible. It's paid with after-tax dollars. So you're really looking at the issue is how much life insurance and long-term disability insurance can you buy? I will say that in terms of long-term disability insurance, for companies that are very valuable, the companies, insurers will not sell as much coverage as they will for death. And sometimes you have a different price in case of long-term disability, and sometimes you have an issue that if somebody is not insurable at regular rates, they'll make arrangements for the differential in the cost of premium, so it's fair. And sometimes if somebody can't get insurance, there will be a buy-sell price, but for that person, there'll be a payout over a period of time because the company doesn't have insurance proceeds. But people get hung up in value. They get hung up in, well, I have this child, Deborah or Sam, who might come into the business. Well, I don't want a mandatory sale in case of my death. Now is now. We'll see if Deborah or Sam ever come into the business, if they get along with other people, if they're contributory, and you can undo the buy-sell agreement. There's very often a failure of vision. People who are, even before the economic turndown, looking to how to run their business, and now they're looking how to survive. They don't look beyond their shoe tops, and they don't think about what life would be like for, let's take the Mel Len Corporation, their brother. If there is no buy-sell, the brother's going to have to deal with the family, and they kind of know the wives don't get along, and it's not a healthy situation. And they don't consider the stress on their own family, who now have to wonder whether they're going to get supported by the business, what role and rights they have with respect to the business. So the lack of consideration for the business partners. There are family situations where there are multiple partners and children, and some lawyers attempt to draft buy-sell agreements that have arrangements with internally on this family. If somebody dies, that then the rest of the kids can have choices, and then if they don't buy the rest, and they get into planning overload, or they get into an issue when they speak to the lawyer, please deal with the issue if somebody wants to leave. I'll give you a hot tip. Except in professional practices, lawyers, accountants, engineers, architects, and others, putting in a provision that gives somebody the key to the door, the first one who wants to withdraw can now say, buy me, is a bad idea. Negotiations will take place if somebody wants to leave. That'll be painful, but result in a more valid answer than filling a couple of pages with the provisions for most businesses other than professional practices as to what happens if somebody wants to get out. Right now, New Jersey's Limited Liability Company Act has a provision which you have to override in an operating agreement that somebody can withdraw and force a buyout. I'm on a committee that's revising that act, but right now, the present act, if you don't have an operating agreement for an LLC, which specifically says no one has the right to put a gun to the rest of the people's head and be bought out, you want to amend that agreement. When there are 2 or more business partners, the company lawyer can take the consensus that's reported and create a template for an operating agreement or a revised one. But there's a conflict of interest. At some point, we must tell you, please have your own lawyer look at it from your shoes only, because I can't. I'm the company lawyer. And there are times when we discover, our litigators discover, that when there's friction, the company lawyer takes sides. Can't do that, but they often do. They sometimes use company money to pay the legal bills to that lawyer. I know it might sound like a commercial to enhance the legal fees of other lawyers, but please believe me, more valid planning, more ethical conduct for everybody arises when in the operating agreement, which deals with not only who's putting in what and who gets what, but issues of whether anybody's going to be entitled to employment who's also a member, whether on what decisions would require what vote. And when let's say there are 3 people, let's say a husband and wife and a brother, or a husband and wife and somebody else who's not family, that's raises a whole issue about the governance and whether or not anybody should have a veto. One lawyer cannot solve the problem because there's no such thing as fair. There is only adjustment of conflicting interests. Let me see if there are a couple of other issues. Again, this limited liability company and shareholder agreements, buy, sell, and other provisions. There are things in here which I've covered and some which I don't have time to cover. This is an hors d'oeuvre. This is not the overture to the symphony. One clunker. The number of lawyers in the state who have drawn buy-sell agreements was mostly populated by tax lawyers coming out of originally a few firms. Wayne, how much time left? A minute or two? I'll end with this remark then. And they copied each other's long and turgid and difficult to read provisions, the ones that make your eyes water. So there's some buy-sell agreements out there in which the approach was used, okay, there will be life insurance as initial certificate of value, but if that certificate of value, which was geared to the original life insurance amounts, not to anything else, is stale, 18 months, 2 years, the accountant shall rule. And the accountant shall look at the change in book value at the time of the applicable event. Well, the answer is that with sub-S's, with limited liability companies, very often there's no change in book value. All the money is pumped out. Nothing is left in there, which might be put in something called the AAA account and change the book value. And book value was not the baseline for agreement on price in the first place. It was the amount of insurance purchase. So this is illusory. Now, there are no easy solutions as to what to do when the certificate of value is stale, but I will tell you this in conclusion. If you do not pay attention in your own buy-sell agreement that you paid some lawyer a lot of money for X years ago, to the fact that the certificate of value is really not fair today, unless there's an issue of oppression, the courts will not come in and say, you know, that's really not right anymore, and we're going to update it. There's no authority in the law, no authority in any statute, for the courts to make a better deal than you made yourself unless there are circumstances the conduct of which would rise to the level of a very serious word called oppression. Thank you.
Bill makes a very good point on the devil is in the details. If you're the majority owner, don't assume that you can do anything, because if I represent the person on the other side, I'm going to be looking at to see how you did it and whether your conduct was appropriate. And you can be sure that, as some of our good friend accountants sit in the room, that forensic accountants get involved in these matters, and how you've behaved over the last X years becomes an issue. So you need to know that if you have a family business, a closely held business that's held by a couple of family members or a couple of just good old friends, when the good old friends, one of them dies, or now the siblings are in the business, all of a sudden things change. And all too easily. So it's very important to be fresh on these things. Don't assume just because you did an agreement 15 years ago that it's valid now. You really have to pay attention to detail. And Kevin O'Connor, who's going to back cleanup for us, is going to tell you what happens when you don't. From a litigator's perspective, we know that all of you would prefer not to be in litigation, at least most of you. I do have clients who love litigation, and we love those clients, of course. Just as much as we love all of those who don't. But we try to keep you out of there, and sometimes that doesn't work because inevitably tempers take control and issues arise. So Kevin is going to tell us what happens when that happens.
Good morning. I think we're getting towards the end, so I'm going to try to be very quick and brief on this. I think a lot of you saw when you came in the gentleman wearing the yellow windbreaker who was armed, which is Kevin Murphy's brother, a police officer locally. And that reminded me that the approach to litigation in the family business context is kind of like got to be a good cop, bad cop approach. Now, the bad cop says litigation, especially in the family business context, is expensive, it's time consuming, it can be a major stressor on the individuals in the business, and in fact, it can ruin the business. Now, Phil before mentioned the issue about oppression. Oppression comes in the context of a statute, the oppressed minority shareholder statute, which the Chancery courts use when there's litigation. Now, that can have drastic results. You can have the court order fee shifting where even though you think you're in the right, if you lose the litigation,